Well, the end of the financial year hasn't been a happy one for global markets. Fragile confidence has been undermined by weaker signs in the US and China, raising fears that the global economy will sink back into recession. While most analysts still don't see a double-dip recession, the sell-off is a wake-up call for those who've been expecting too much from the recovery. Here's Philip Lasker.
In trading rooms around the world, they're asking the same question. Is it all going pear-shaped?
We're having a mid-cycle slowdown in China. We're having troubles with sovereign debt in Europe and very weak growth, and also signs that the US recovery is starting to lose momentum.
All these factors have combined to drive equity markets lower at a time when the risk appetite is quite weak. Softer consumer confidence numbers in the US was the latest shock, but some say markets have only themselves to blame for their bloated corporate earnings forecasts.
Now, the US recovery, for example, was forecast to be the third worst recovery since 1873, and yet analysts were factoring in, that's out of 21 recessions, analysts were factoring in the sixth best recovery in those 21 occasions.
The forecasts were implying a very aggressive V-shaped earnings recovery. In the US, earnings forecasts were looking for a 80% increase in earnings between 2009 and 2012. And it was a very similar story in other developed equity markets. So that would only go hand in hand with getting a staggeringly strong macro recovery, something that we've never thought was likely to unfold.
Markets, it now seems, are coming to that view, even if US President Barack Obama, flanked by Federal Reserve Chairman Ben Bernanke, attempted to shore up confidence and point to problems elsewhere.
We share the view that the economy is strengthening, that we are into recovery, that it's actually led by some interesting sectors like manufacturing that we haven't seen in quite some time. Unfortunately, because of the troubles that we've seen in Europe, we're now seeing some headwinds and some skittishness and nervousness on the part of the markets and on the part of business and investors. And so we're still going to have to work through that.
Those troubles in Europe are one reason falling long-dated bond rates are pointing to recession.
We are seeing some safe haven flows into particularly the US Treasury market because of the concerns about the quality of government debt elsewhere. The second thing is there's a growing view, which we do agree with, that the Federal Reserve is going to keep short-end rates very low. So that's quite important to investors when they look at the gap or the spread between short rates and long rates, and that normally is fairly tight and it's dragging down the long end. And the third is, yes, we are starting to get some weaker macro data in the States. So there's 3 or 4 factors coming together there, but we think it's a mistake if you think the bond market is flagging recession, or if the market is flagging recession, we think this time it's probably going to be wrong, at least on a 2 or 3 quarter view.
But talk of a double-dip recession has a more realistic tone, even if a majority aren't calling it.
I'd put the chances right now at about probably 15-20%, but 3 months ago I probably would have had that at about 5%.
The prevailing view is that Asia and world stimulus measures will pull the economy through this year. A recession could come later once the immediate threat has passed and governments take an even more aggressive approach to reducing debt. Whatever happens, it's likely to be some time before investors can confidently declare the bull market has arrived.